We will look at 4 aspects of the structure of the financial system: the size of institutions, the degree of public sector ownership, the degree of foreign ownership, and finally, market concentration. With respect to each of these aspects, we will ask whether it makes a difference for SME finance. So first, let's look at large versus small financial institutions. Large financial institutions may have a comparative advantage at processing hard information because of economies of scale. They can therefore be expected to be better at developing the types of transaction lending that we talked about. On the other hand, small financial institutions may have comparative advantage in processing soft information because it is costlier to transmit within large organizations, or because of smaller agency problems. Smaller institutions typically have fewer management layers. What is the evidence? Not surprisingly, data confirm that larger financial institutions are better at financial statement lending, and smaller financial institutions are better at relationship lending. However, data fail to establish any clear link between the share of large or small financial institutions and the availability of credit to SMEs. It may be that the availability of lending technologies offered by non-banks, such as factoring or leasing, is more important than the size of the banks. State banks are typically larger, and so a priori can be expected to be better at transactions lending. Furthermore, they usually have government subsidies and mandates to lend to SMEs and other groups. On that basis, one might expect them to be more prone to lend to SMEs. However, state banks are also often associated with politically motivated lending. And this decreases market discipline and the incentive to fund creditworthy SMEs with profitable projects. Politically motivated lending also decreases incentives to monitor credit quality. What is the evidence? Like in any financial institution, credit decisions should be subject to effective governance and independence. If that is the case, state banks can serve well the purpose of promoting private sector development. However, as many empirical studies show, political interference often hampers the volume and quality of their lending. Now, what about the degree of foreign ownership? Foreign financial institutions are typically large, and so may be better in transactions lending. In many cases, they may also have better access to information technologies and financial innovation. Foreign banks are also less likely to be prone to politically motivated lending. On the other hand, they may be less effective in relationship lending, since cultural and institutional differences may create disadvantages for them. What is the evidence? In most empirical studies, foreign financial institutions are associated with greater availability of credit to SMEs, at least for developing nations. This may be evidence that, as we saw when we discussed lending technologies, the right types of transactions lending are more suitable to SMEs than relationship lending. Finally, let's look at market concentration. The theory is ambiguous regarding the role of market concentration in the financial sector. A priori, one could expect that financial institutions with more market power would charge higher interest rates and restrict credit. Lower market concentration could also be expected to have a positive impact by increasing incentives to adopt new lending technologies or seek new and in particular smaller clients. All this would improve the availability of credit to SMEs. However, on the other hand, high market concentration may encourage financial institutions to invest in closer relationships with companies, including SMEs, because they have lower chances of finding alternative sources of financing. What is the evidence? Empirical studies are indeed ambiguous and do not show any clear link between market concentration and credit to SMEs.